Hey guys, welcome back to Results Junkies podcast. I am on the road while Paul is still driving from the basement, and there's lots out there to talk about in the AI world. We're going to focus a little bit on Elon Musk, though. Even though that's a big name, it's really a sign of what we're seeing in a bunch of places in the AI world right now. And if we don't wander too far away on that topic, we might talk a little bit about a question that Paul and I were pondering in the pre-show about founders and what makes a good founder versus a bad founder, and how they find their path, if you will. Paul, as I sit here, we're a few weeks away from showing up in South Dakota for the first tour stop of 2024, and I realize I don't I don't really think I have a jacket that's going to protect me for this trip.
Yeah, that would make 2 of us. I have made it a point not to Google the weather in Sioux Falls in February, so, yeah, well, you and I are both in for a surprise, but I will tell you, in fact, I do not have anything that's probably gonna keep us as warm as necessary up there, so,
Yeah, you may
I'll
be
just
doing
have to
yourself a
be
disservice by not
well
Googling. I went out and I've now posed questions in my Slack community for my other podcast about, hey guys, the last time I bought a winter jacket was 2005. Bought a really nice, what was a great North Face at that point. It has absolutely outlived its usefulness, and I'm gonna need some recommendations because I'm going to Sioux Falls in a few weeks, and so the recommendations are coming in. But I will say, I don't know what I certainly don't know what it's gonna be like when we're there, but there were a few days where the temperatures did scare me a bit.
well, I think I don't know what to tell you other than actually 2 things. Number 1, you're supposed to get me into that Slack community. I'm gonna
Oh,
call
that's
you out
right.
publicly
That's
now.
right.
And then secondly, I think, we just might have to be a little bit more animated during some office hours just to,
To stay
raise
warm.
those internal core temperatures. We'll flip a couple tables and talk to some entrepreneurs, so
Yeah, just for perspective, average high in Sioux Falls, South Dakota in February is 31, average low is 11. So the 31 doesn't really scare me, but
yeah,
I can't say I'm too wild about the 11. So we'll just have to see when the 11 comes up, and
I'll
maybe just not go outside then.
I'm gonna pack some light gloves. We'll see how that goes.
Good lord. If you're just tuning in, show at resultsjunkies.com is how you can email us for questions, comments. If you want to present on the show, pitch your company to us, all that good stuff. On social media, he is at Paul Singh, and I am at Pizza in Motion. So let me frame up these two stories real quick, and we go from there. So they're different but related. So there's a report out, and this is a fairly new report that came out last night from when we're recording, that Elon was asking for more equity in Tesla if he was going to continue to develop AI stuff inside Tesla. And I would say, just as a high level, without editorializing too much, there is an interesting concept about recapitalizing companies to make sure the founder has enough skin in the game. It's something that we've done as investors. So there is precedent for this, but this is also a publicly held company, which is a bit more unique. On the flip side, Elon is also raising money for his own AI company, XAI, which in theory is supposed to be more narrowly focused just on creating a competitor to ChatGPT. But to some degree, AI is AI, and so there are a number of questions here, about investors, founder optionality, and protected work product. I mean, seeing a lot of the same things that we saw with the OpenAI and ChatGPT just a few weeks ago.
Well, I think okay, so there's a lot to this. I think that, I think the first thing is that founders with a lot of leverage, in particular ones like Elon Musk and, Sam Altman and stuff like that, they have the ability to negotiate deals that might be a little bit different than the norm, right? So, to your point, like, it remains to be seen, what the public markets will say about Tesla if they recap the company to do this. But that being said, though, celebrity founders and stuff like that, do have the leverage to demand maybe a little bit more. The other part of this that I think is really interesting, so there's a couple things I think are really interesting about this. Number 1 is the timing. We're talking about half a billion to $1 billion going into these efforts now, given, the high interest rate environment right now. Like, clearly, whatever the upside is on something like this, private market investors believe that the returns will be much, much greater than what they could do by, just parking their money somewhere. So that tells you how big
Right.
the opportunity appears to be. The other part of it is that, like, the other part or the next part that's interesting here is that, in particular, let's just talk about Musk, for example.
Mhm.
Musk's track record is to manufacture things, I mean, between SpaceX, Tesla, right? Like, even X, like he's a builder, and
Right.
he employs engineers. So presumably the money he's raising to do this is going to eventually build not only a potential competitor to Nvidia, who is doing billions of dollars a quarter right now, but potentially build hardware that is hyper optimized for the problem set that they're trying to deal with. In particular, when you think about, and I'm just speaking in broad strokes here, right? But like for example, when you think about the use cases for the OpenAI API, there's no real expectation of real time. I mean, if you read the terms of service, like it basically says like you're not allowed to use our APIs for anything that's, depending on life or anything like that, right?
Right.
But Tesla presumably is building, the fact that whether or not this happens inside of Tesla or adjacent to Tesla, the use case is entirely different. A car drives down a street and sees something walk across the street or move across the street. It has to compute in near real time to figure out whether to stop the car or to swerve the car. So these are two very different use cases. So that's the next interesting bit here is that he's got a manufacturing background and he's got his own built-in customers for this, you know. So that's the next part that's really interesting. And I think actually let me pause there. Let me pause there. What's your gut there?
Yeah, I mean, the thing that I'm having trouble I think the reason why I'm having trouble figuring out, to your point about the investors and their thinking, is it's still unclear to me what the horizon is, for something like this, especially because there's different bits and pieces here. I think the 2 obvious big chunks here are, first off, when is some sort of a chat GPT like product going to generate the sort of revenue that would ultimately generate the sort of return that investors would want? That still feels like it's a long time away, and maybe I'm just misinterpreting the horizon. And then when you talk about creating hardware that's hyper focused on the activities that somebody like Musk might want to develop things for, I mean, there's a reason why NVIDIA eats everyone's lunch in this space. It's not an easy problem to solve. And so you've got a couple of different things there. And don't get me wrong, I think Musk is entirely capable of doing this, but you not only have to figure out how to design hardware that will do these things, you then need to manufacture it. And my understanding of NVIDIA's manufacturing process, because of how exacting the principles have to be on some of these devices, is that it is some of the more complicated manufacturing that exists in the world.
Yeah. Yeah.
And I think those are two very different questions and two very hard questions to answer.
Well, I think those are that's fair. I think that directionally we're heading towards more need for GPUs, not less. We're directionally heading towards a world that needs more compute infrastructure, not less. I mean
Mhm.
that's been the truth for the last 40, 50 years, right?
Sure.
So the if I had to like, kind of guess on this, I think the thing is that look at what they've done with Tesla recently. They've started to license out the supercharger network to other
Yep, we talked about that, yeah.
manufacturers. There's reports out there that they're talking about licensing out the autopilot feature to other manufacturers as well. So they're kind of following the the Amazon playbook, right? You sort of build infrastructure for yourself, which is a cost center, but you throw an API on the front end of that thing and you turn it into a revenue center.
Well, and
Maybe that's a poor analogy, but it's a close.
no, for that of the 2 questions I had, for that question, I think to your point, the if somebody were to bring me a business model right now that said, "We're gonna raise a metric crap ton of money to build an NVIDIA killer," I would say, "I am not interested." In this specific example where you're talking about if you're gonna design the product for a specific internal use, it becomes much more appealing because the underpinnings of that cost structure should be the revenue you can generate from whatever the associated product is. Still a
Uh,
very complicated problem to solve, but to your point, I think there's a difference between creating the next NVIDIA competitor and creating a model that serves an internal customer.
yeah, I mean, okay, so just to touch on one important bit there, you wouldn't say no. So the way you just worded that, you said like if somebody said they wanted to raise a bunch of money to do this, you wouldn't do it because of X. I agree. I would say the same thing, but primarily because I've been really open about my own investing for more than a decade here. Like one of the things I won't invest in is anywhere where it costs more than $1 million in aggregate to get to your first or second customer. That doesn't mean it's a bad deal. It just means that for me as an angel and the
Right.
portfolio I'm trying to construct, I can't over index in one bet. But certainly there's a lot of other players upstream that will absolutely take that bet, whether we're talking about sovereign funds or very large venture firms on Sand Hill Road, or even corporate investment firms. I mean, that's why they exist. They don't exist. Those things, those big entities don't exist to fund the next SaaS startup in, rural Michigan. They exist for these sorts of like heavy infrastructure, big, big, big bets. So, yeah, I mean, I think coming back to the original point I think you brought up that I don't know that I have an answer to here is like where do you draw the line though on interrelated businesses but that are explicitly carved out like the simple setup of this, let me just set this scenario up for people in case it changes your mind on things. Like if I invest in a particular company and, you know, you are the founder, well, there's an implicit understanding that I'm betting on you, even if I've put the money limited to be used in, the normal operations of the business. But if you then go on to, potentially create the number one vendor that the company I invested in is going to pay money into, like, it's starting to get a little weird. you know,
Yeah.
you
No,
know?
I agree. I told you in pre-show we had a company. I won't name the company because it was never public, but it's a company that's become very successful. And at the time, we met the founders at Techstars, and we were going to lead their seed round, and we gave them a term sheet. And one of the conditions in the term sheet was that the founders were effectively running another company at that time, and we wanted to have a conversation around how much time they were going to spend on one business versus the other. And as we started to have that discussion with them, because there was some general concern of who was spending their time on what. They're while these were very brilliant individuals, they were clearly not sure which direction was going to be the most successful in that moment. They ultimately ended up deciding to just bootstrap and go their own way, and we didn't invest in them, and they became incredibly successful. So, and I don't regret the decision that we made, but it is this question of, would you know, if you know that Elon is developing now a 4th product and also raising money for it in an adjacency, because I think the thing about I think it'd be fair for an investor to have a concern about whether Elon is spending too much time on Tesla without spending too much time on, X, Twitter, if you will. Like that's a valid concern. It's like, hey, like, you used to spend 80% of your time on Tesla, now you're spending 30% of your time at X. Do I get the same value for my investment in, Elon Musk? When you're talking about now this adjacency for AI, when he wakes up in the middle of the night and has an idea, which company does it go to?
Yeah, that's a good I mean, I think that's the question everybody's gonna be asking here, because unless you're an investor in all potentially all 4 of these companies, you're probably wondering, like, where the IP goes, where does every because that's the thing, right? Ideas we all know ideas are not valuable until the execution's applied, and then all of a sudden, everything's really valuable very, very quickly. So, you know, does that go to, Tesla? Does it go to SpaceX? That's the big question everybody's gonna ask, I imagine, in the long term. Um, but I think there's look, it's not like he's going from 1 to 2 companies now. Like he's clearly figured out some formula to go from 1 to 2 companies and then 2 to 3 companies and now potentially 3 to 4 companies. I mean, he's raised half $1 billion according to this report already. So maybe someday we'll get to all see the discovery, recap of like how he did this and what the terms really were. I don't know. But, uh,
Well, and
uh,
and so far this announcement that he wants more stock from Tesla to have, more control, it's early yet. Doesn't seem to have affected the market. The stock has opened up a couple percent, though, for time recording, it's just a few minutes after the stock market opened. And I was curious how the stock market will react because essentially what he's saying, which I think is odd, and I think this goes back to this discussion about investors and founders. It's less about Elon, but Elon's argument here on why he should get more shares in Tesla is because he wants to have a more more impactful say on things. But he's not asking for a veto right. And so I have this concern. This sounds an awful lot more like a financial incentive than a voting incentive because I think, as you know, while having 15% of the voting shares for a specific company is less meaningful than having 25% of the voting shares of the company, neither one is overly impactful for major decisions.
I agree. The other way I would say this is that for influential people like Elon, he doesn't need explicit control because he kind of has implicit control.
Right.
You know, he owns the media company that can talk about you, good or bad. So he's got optionality. So I think this is like sort of I don't mean to be like, you know, a high schooler about this, but this is like the big boy stuff, right? People think that you need to have 90% control on something or 51% explicit control on something. And maybe that's true if that's your only way to influence something. But for people like Elon, where he's got a massive brand, a huge audience, stuff like that, I mean, he could theoretically own 1%, but his influence outweighs everybody else's. And, obviously nobody ever wants to go nuclear, but it's that deterrent that. So anyway, but it's interesting because I remember reading that. I thought the language on his request, I mean, assuming they copy and pasted the language directly from his letter, I thought
Right.
the language was really fascinating. He basically, in as many words, said like, if you increase me to this amount of ownership, I'll do it inside the company, and otherwise I'm doing outside the company. And I remember, I wish I knew the numbers off the top of my head, but I remember thinking like, okay, that number, the X to the Y that he's trying to go to does not seem like a very big percentage. I mean, obviously it's a big percentage to anybody getting diluted, but
Sure.
it's not like he's going from like 13% to 72% or something like that. And I was like, huh, okay, that seems strange, like, you can either own 100% theoretically, a big piece of a big pie on the side, or you're asking for a slightly bigger piece of Tesla, like, what I just thought it was just it's not intellectually like what I thought it didn't seem apples to apples, unless I'm
Yeah.
missing something,
Well, and
but
along the way, you're asking everybody else in Tesla to take a haircut because
right.
ultimately
It's
it's a
gotta come
publicly
from
held company.
somewhere.
Yeah,
Yeah, that
well,
equity has to come from somewhere.
they have
So
to issue more shares, essentially. I think of another way you tackle this, this issue. So I mean, is it a
well, it's one
shareholder
of 2
vote or
ways.
proxy vote or what? But I mean,
Well, it's either dilution or it's there's 2 ways to get that equity. The first is dilution like you're talking about, and the other is this is sort of the implied call like, "Hey, if you wanna get out, it's time to sell right now and I'll buy it up."
but I think yeah, well, yes, but in the statement, he's not offering to buy it. It's
That's
just
fair. Yeah,
he's
from what we know, yeah, he's not. Yeah.
yeah, yeah,
Uh,
that does not appear to be a beneficial offering at stake here. It's more
right.
like, I would just prefer to own 10% more of this company to keep doing the thing that I'm doing.
Well, I have to assume that we know how the board responded because I thought the headline what was the headline there? The headline was yeah, so Reuters is oh, yeah, okay, so Reuters is saying Musk denies the report that his AI company secured 500 million towards the 1 billion funding goal. Come on. Well, I can deny that I bought a $3 coffee yesterday, that's immaterial, but to deny a half a billion dollars, that's really more like, "Yeah, I don't wanna, like, piss off the SEC because it's an open fundraise right now, so I'm just gonna deny it." Come on. That
Yeah.
the fact that that's out there right now tells you that the board disagreed and Elon has decided to go on the outside. That's right? Like, you can't undo it.
I mean, I would I
I
would
mean, I guess
I would
Elon
normally
can
s
do
I would
anything he
normally say
wants, but
yes, just given how erratic specifically Elon is, it is entirely possible the board has not given him an answer and he just, went out and penciled in a half a billion dollars in interest for an AI company. Maybe he hasn't, maybe they haven't signed papers to,
that's
to
fair.
pull
Yeah,
the money in. This is one individual that does have an incredible reach, whereas, like, you take the Sam Altman example here, and like, we continue to see reports of, like, Sam Altman, globetrotting around trying to line up investors to have deep pockets, whether that's for, you know, hardware so that he can be less reliant on Nvidia, or he's building his own separate company. There's sort of like he's doing the roadshow to try and talk to some of the folks that I would imagine that you just mentioned, the sovereign wealth funds and stuff like that, to be able to do this, because ultimately, I think in using the Sam Altman example, and this goes back to that question I had for you about, like, the horizon for this. I think you'd agree, raising this money in, like, a typical investment round, the amount of money that you would need to bring to bear to be able to do what Sam Altman wants to do, it really the capital has to come from some of the deepest pockets in the world if you're gonna quickly ramp up a competitor to NVIDIA.
I mean, I don't. look, this is above my pay grade, and I don't want to sound super alarmist or anything like that, but I think this GPU battle is the next Cold War. I mean, it really is. And I think, look, even for myself, I mean, I've said to you in the past, like, on the one hand, it's hard to consider building on top of the chat, the OpenAI APIs, just given like the risk and all that.
Yeah,
But on the other hand, like the more and more I've been thinking about it over the last couple weeks, it's sort of inevitable. Like, and at some point, nearly every one of the companies in our portfolio, in our respective portfolios, are going to have to decide whether they're going to use it, AWS and rent out GPUs, or if they're going to go buy a bunch of cards, or in the most extreme case, build some of these things. Now, again, build is a very different price point. But I,
yeah,
I guess I'm just coming to terms slowly over the last couple of weeks that, we're going to see the need for more compute power everywhere. I mean, look at like even this piece of software we're using, StreamYard, and even before this, we were using uh,
Riverside.ai.
Riverside. I don't know if you remember, but like, let's just use Riverside as an example. Right after we recorded, it would go drop us into that little studio thing or whatever, and it would say, "Here are your recordings. Here's the
Yeah,
transcription," or whatever. They're using GPUs for that. Now, they're probably using like, AWS or whatever they're using and renting it or whatever. But the thing about the cloud is that it makes a lot of sense until all of a sudden it doesn't.
right.
Because what's baked into the cloud price is the ability to go up and down. But if you have a steady compute need, you can just model that out on a spreadsheet real quick and find out that you're better off just buying the hardware and hiring like a DevOps guy or gal, and you'll still come in under what you used to pay. So anyway, that's a
Well,
longer discussion for a bigger, episode maybe, but
yeah, let me push back on that for a second though, and I'm not sure I'm nowhere near sure I'm right, but I think one of the other reasons why I would be hesitant to consider investments in some of this stuff is it is unclear to me how quickly the hardware is going to be obsolete at this point.
agreed. Agreed. Yeah, I mean, you have to bake in a lifetime. Like, you're not gonna amortize this hardware over the course of 5 years, probably amortizing it over the course of 18 months or something like that. Maybe.
Yeah, I don't know,
Um
and so I think that makes it tougher on the R&D side because if we think about car companies are like a great example of that even though we're talking about servers, but, like a car company does R&D on something, and they build a system, and then that system lives through 5, 6, 8, 10 models of that car.
Mhm.
Maybe it's tweaked a little bit, and the color of the button's a little bit different, or the shape is a little bit sleeker, but the underlying technology is used in a number of generations. And that may absolutely be the case for the hardware that's being contemplated in these, huge raises that like the Sam Altmans and the Elon Musks are considering. I just don't know that we know enough. Yeah, I certainly don't know enough yet to know what the how would you how what sort of a time horizon would you amortize the R&D costs over for this hardware? Because it's unclear whether the next generation of these devices is going to be 2% different or 30% different.
Well, yes, fair question. What I would say to that though is that that exercise has been done already and in similar areas. Let me just rephrase. I think I've kind of I don't talk about this too much openly, but I've been doing data center stuff for 20 plus years. And the thing is like our hardware inside those facilities, generally speaking, the hardware itself is amortized over the course of 10 years because even when it's not top tier, right? So let's just use a let's just use a large network attached storage device as an example, really basic example here. Let's say we pay $1 million for a piece of hardware that's the size of, you know, a semi trailer or whatever.
Right.
That could be tier one, grade A, best of the best hardware for 2024. It's not, maybe the best clients don't want it in 2026, but it's not necessarily trash. It's still usable by the next. There might be another set of customers that are willing to use that hardware for the next 5 years. I guess my point is like generally speaking, if you were to like talk to some of the finance guys that come out of the data center world, there are models that you or that you plot your usage curves on, and like Moore's law is heavily baked into some of those models.
Sure.
So the point is though is that like, I mean, one other example, by the way, is just go on the pricing pages for Google Cloud Compute or Amazon web services compute. Just go look at the pricing page, and what you're gonna see is, like, off the top of my head, like 10 different levels of servers you can get, a lot more than that. But it's the thing is, like, they didn't start out with 10. Whatever the lowest tier is or the cheapest one was actually, like, the most badass version of whatever you could get 5 years ago. It
Right,
just sort of
right.
gets shoved down, the list. So it's getting used. I mean, they're probably extracting every, penny of value out of that thing until the power supplies die, and then even then, they're probably rating it for parts and then turning it back around. So, yeah. Anyway, it's a
It's
really interesting. But I guess what I'd summarize that by is it's a good question that you asked, but it's a purely financial modeling exercise because there's a lot you don't know. Nobody ever knows. Yeah.
Yeah, I think, and to your point, I think, and I'm not trying to put words in your mouth. What I think I'm hearing you say is that while the hardware modeling for, the devices that the Sam Altmans of the world are trying to build won't be the same as what AWS are using today, that the life cycle of those units will rhyme with them, if you will.
Oh yeah, probably. Yeah. Yeah. Like, I mean, think about it this way. I thought the most recent report out of OpenAI or NVIDIA was that OpenAI or Microsoft has pre-ordered like 100,000. I think they're A100s or H100s from NVIDIA at a price
Right.
of $30,000 a piece.
Right.
Huge capital expenditure that only very few clients can afford to make.
Right.
But that hardware obviously won't be top of line the next year, but that doesn't mean it's going to be obsolete. It'll get just shifted further down the compute stack, So I don't know. I think, but here's the summary of all this. I think that if you just kind of zoom out and you look at like the Sam Altmans and the Elon Musks of the world now raising money or talking about raising money for these heavy infrastructure, heavy compute farms, if you will. I think what it's implying is that they both see a future in that requires more compute and potentially more real-time compute. That's the
And
interesting
the
part is like, what is that
and
real
the
time gonna be used for?
and the scalability of price or productivity to cover that. Because
Yeah.
I would expect the cost of this hardware to go up considerably over the next 3 to 4 years in the aggregate, only because of all the R&D costs that I think will go into, folks getting into the business, if you will. Like
Oh,
NVIDIA's
yeah. Yeah.
NVIDIA's cost isn't necessarily gonna go up. Like, it's an interesting comparison when we think about, I mean, essentially what we're talking about here is, I'm gonna put my airplane nerd hat on for a second. Boeing and Airbus are essentially a duopoly, and they have, 10-year order books on all of their planes because they're the only ones that produce those airplanes. And Sam Altman and Elon Musk are sitting here looking at companies like NVIDIA and saying, NVIDIA is the current Boeing. We're just gonna go out and make another Boeing. For somebody to decide to get into airplane manufacturing now and to compete, the massive amount of cash up front that they would need to burn to catch up to a Boeing or Airbus is why it's a duopoly. I mean, regulatory and all that stuff. Here, I mean, the Sam Altmans of the world are betting that not only can they get into the game fast, but that they can deploy enough devices to catch up on what's gonna be a really aggressive R&D curve.
And they're doing it in an environment where I mean, so, like, when you talk about those airline, manufacturers or, like, some of the competitors that are coming up, whether it's Boom, Supersonic, and all these other guys, like, with all due I don't know anything about aerospace engineering, but with all due respect, they all raised a ton of money during a zero interest rate environment. That
Yep.
doesn't I'm not taking away from the ideas or anything like that. I'm just saying that, like, they raised money at the right time when there was less yield everywhere else. Just the possibility of building, being part of the next airline manufacturer is a big deal. Conversely, one of the things that's very different here is that you've got at least these 2 guys raising hundreds of millions of dollars in a, extremely high interest rate environment. And again, I think it speaks to it's not just about taking a bet on Elon or Sam or whoever the personality is. I think it shows you that investor sentiment is telling us that, that investor sentiment believes that GPU infrastructure or compute infrastructure has the potential of returning quite a bit more money right now. So it's sort of, it's like the what's the invisible hand of the market, right? Like the invisible hand of the market is telling us that rather than have safe 5% returns every few months, they'd rather have the chance of blowing it all away if it means that there's a possibility of massive, massive upside. So it's still above your pay grade and mine, though, man. I'll tell you what.
Well, and you talk about the interest rate environment, and I know we got a bolt, but I just figured I'd mention this. I listening to another pod on the All In podcast. They were talking about this, I think last week. Adam Newman, the ex CEO of WeWork, started a new company that focuses more on apartment buildings. And I haven't dug into this yet, but according to what they had mentioned on the show, he purchased tons and tons of apartment buildings, thousands of them to sort of seed the marketplace for the new company he's growing. But he did it, and the debt that he put on top of the company was all variable interest rate debt. And it's like, wait a second. And he started like he got the debt in 2021 and 2022, and now the interest rates have spiked and he's having trouble making interest payments. And it's like, wait, huh? And so that's where it's like, I mean, this whole concept of how you finance something and fund something in this environment with where interest rates are. I mean, I get the sense that, with for how long rates have been higher than in most of our adult lifetime. Like I remember when I bought my first house back in the early 90s, interest rates were 6-7%. But
Mhm.
it's been 30 years. In an interest rate environment this high, it feels like, and we should probably get into this in another episode because I know we got to go, but it feels like we are just there must be so many companies that are right on the edge of extinction, and interest rates are creating a high pressure environment for them. And it's like, can they hold on until the Fed starts to lower rates? And it's so hard to know how many of those that are out there because as you said in pre-show, it's really hard to raise money right now. And that's gonna continue until interest rates come down, and it's like, how long can these companies eke out another quarter in the hopes that the market changes?
Well, that's yeah. That we should pick that up at some point and talk about it because that's sort of the under what is it, the undertones of why I'm pushing on our mutual friend that we talked about or in pre-show is that like you know if you're going to go down this venture path, you got to be realistic about the bets you're going to make. And if the bet is, hey, I think I might hit these milestones, that's one thing.
Right.
If the bet is, hey, interest rates are going to come down and I think it's going to be easier to raise money in 18 months, that's an entirely different thing. And, everybody's got to be honest about that. If I'm going to take a bet on something, or if you're going to take a bet on something, we're okay with the bet as long as we know what the bet is. But a lot of times I see a lot of founders all over the country and the world that, saw something on Shark Tank and, shoot themselves in the foot because they said the wrong thing and misunderstand like what kind of bets we're going to take. So we'll see. So anyway, let me pause there.
Yeah, we should definitely pick that up, and maybe we'll bring that person on the show as we talk in code. So more on that later. A mere 3 weeks before you and I are huddled in the cold of Sioux Falls, where we'll be doing donuts and quiche and 24 hours of the startup ecosystem.
It's gonna be fun. I love it, man. All right, well then I will see you soon. I hope you enjoy that hotel room. It looks so
That's very exciting,
cozy.
especially the sunlight coming right down my face. It's perfect. This remote recording stuff is all that and a bag of Fritos.
You get a nice little pan. It'll be nice.
Yeah, perfect. Yeah.
All right, man. Good luck with the meetings.
Peace.